The Best SaaS Stocks is the title of today's presentation, and every investor is going to have a different definition of best, but what we're going to show you today is a method for screening SaaS stocks that you might find useful and hopefully learn something about the SaaS stock universe. Now, in order to find the best SaaS stocks, we ought to consider all of them, so we need to create a universe. Well, we're going to use the SaaS metrics listed on Blossom Street Ventures and blend some of our own metrics with that. We're going to define some parameters. So we have a tech investing methodology that we follow that provides some objectivity to our madness. And for example, we're going to target only companies with a market cap of greater than $1 billion. That rule is not unique. You'll see index providers such as MSCI set similar rules, and it's to filter out smaller companies that aren't so investable. We're going to consider metrics like growth, valuation, guidance, and retention rates. And what we're going to do is start with data from Blossom Street Ventures. They claim to follow every publicly traded SaaS company in the United States, but their data only includes SaaS firms that had an IPO in the last 3 years. So we're going to supplement their data set with stocks in our tech stock catalog, which contains 460 tech stocks. You filter on the column SaaS in that catalog, and you have pure SaaS, some SaaS, no SaaS. We filter on the pure SaaS and then go ahead and add 9 more companies. That gives us a total universe of SaaS stocks of 73. So then we can start separating the wheat from the chaff. So, as we said, we only invest in companies over $1 billion in market cap. We're only interested in companies that are experiencing strong growth, and we want to consider valuation. So we use what's called a simple valuation ratio, which is market cap divided by annualized revenues. We don't invest above 20. So let's start with market cap. Now, we filtered out to start 14 companies that have a market cap below $1 billion. So Excel has an easy filter option that you can use on data sets and just click a drop down. So you click autofilter and click drop downs, and it's very easy to start playing around with data. Now, the first thing you're going to notice here is an acronym that you may not be familiar with. We weren't. NDR. What's that? Well, net dollar retention versus net retention rate, NRR. They're exactly the same thing. What this shows is how much your customers are spending relative to what they were spending before. Let's take Expensify as an example. This is a company based out of Portland that we thought was total rubbish. So they want to get involved in politics, and 10% of their transaction revenues on cards go to charity that the CEO designates instead of fixing the problems in his own backyard. Portland's an absolute mess. He chooses to go solve problems in other cities, and was very political in the past. We called that out in an article on the company, and as we expected, a firm that is not only chooses political sides, but also dabbles in employee expenses isn't going to do very well in a recession. And as you can see here, look at their year prior net retention rate. It's 119%. You see that? And their latest net retention rate is 98%. That's bad. It means that clients are paying them less, existing clients. So could be that they're renegotiating contracts, could be any number of reasons. But when you look to the right of that, and good on them for providing gross retention rate, GDR, so gross dollar retention, what we call gross retention rate. That's your cancels. So you see here, their cancels are 12% of the money that they're bringing in was lost to cancels, and you can see for these other firms. So about average, let's say high 90s is what you want to see. Anything in the low 90s, starting to go below that, is bad. And then when you look at other firms, for example, let's look at Infusion. You can see they're moving in the right direction. So they had prior net retention rate of 111%, and now it's 120%. So existing clients are spending more over time. So we drop these firms off because they're too small. Then we move to look at revenue growth. And here you can see metrics for a number of firms. What we're looking at simply is the year-on-year growth. So you have fiscal years and you have all this rubbish. This simply takes the last year and looks at, well, how did they grow over the last year? And we did an exercise not too long ago which looked at last year's growth versus guidance going forward. And you take the delta there, and that tells you, well, how much are these firms adjusting their expectations in the face of today's macroeconomic headwinds? And it tells you something. UiPath was one of the only firms we spotted that actually increased guidance in the face of macroeconomic headwinds. That's because their solution saves customers money. You'd expect that when you have difficult times in the economy, that firms that save other firms money are going to do very well. So when we look at companies here, we see some familiar names in there that we've covered: Informatica, Splunk, C3. We've simply removed these firms because their historical growth, at least over the past year, hasn't been so well. Again, you can adjust this. You could go ahead and take compound annual growth if you wanted and look backwards, but we've simply eliminated these 11 stocks and brought our total down to 48. Now what we can look at is valuation. This one becomes rather tricky. So one of the reasons we use annualized revenue is that it's more dynamic than price to sales. And the recent jump in NVIDIA's share price was a good example of how well this ratio adjusts to sudden change. Now, at the top of the list is Snowflake. We're holding Snowflake. We only add at a simple valuation ratio of below 20. So when it dips below 20, and it occasionally does, we'll add some shares. CrowdStrike, I think we're adding anywhere in the range from 10 to 13. I think the last time we added was at 11. Then you have Palantir, and you can go down the list here. Now, for today, what we're going to do is be picky and lower that to 12. So we're going to say, well, we only want to invest in firms that give us a decent valuation, so a proper entry point. 12 is double our catalog average of 6, which is calculated for around 190 different tech stocks. So what you'll notice here, these 13 stocks we're eliminating, there are actually some good names in there like CrowdStrike, Snowflake, Confluent, Samsara. We're holding all of those firms. So we remove these, and then we're brought down to a 22 stock set. What we can do now is look at firms that have guidance going forward of 15% or less, and a fair number have, again, these round numbers, these cutoff points. You can provide some buffers around those, but we're simply going through this exercise with some hard numbers just to show how you might screen a set of stocks. So we're dropping off some more names here, and you see DocuSign. Well, we've written about their poor guidance for the coming year, and then there's Alteryx, which is right at the cutoff point, and AvidXchange, that's a name we're actually holding, in place of another name we'll talk about in a second that we'd really rather be holding. But we're going to eliminate 13 more stocks, bringing our new total to 22. And then what we're going to do is look at net retention rate. Now, if you just increased your prices by 5%, let's say inflation, then that would mean you would have a net retention rate of 105%, right? You're increasing by 5% every year. And that's not growth, right, for existing customers. So we've eliminated these 3 companies that aren't seeing net retention rate greater than 115%. So then that brings our new total to 19. Now, these firms are what are remaining only after we filter out companies that we already have covered. So if we take that remaining set, 4 we love, which means we hold them. 3 more we like, we'd consider owning, and 2 we're avoiding. So those 9 stocks, premium subscribers have access to that information. So if we filter out those 9 firms, we're left with 10 promising SaaS firms we can dig into more. And look at these names. So I'm not overly familiar with any of these, to be honest. So Asana we use here at Nanalyze. That's how we... If you request us to cover a company, for example, on YouTube, or if our premium subscribers make a request about covering a particular firm, we'll put that in Asana and assign it to a researcher. So we use that kind of as a workflow tool. And Sprout Social, we use one of their competitors for social media that's cheaper. So those are really the only companies here off the top of my head that I'm familiar with. So we're going to go ahead and take this list and do a follow-up video and examine these names further. But you're asking the question, which is the best? Well, it depends. We're looking for new stocks to cover, so our parameters are certainly going to be different than yours. For example, Bill has the best revenue guidance of all the SaaS firms we've looked at today. 62% growth expected. Honestly, we'd be holding Bill if we weren't already holding AvidXchange. And we've detailed that in research pieces. Why we held AvidXchange in the first place was because they were reasonably valued and Bill was completely overvalued. And now that that's changed, if we had to make that same decision today, we might make it differently. And you have look at things like net retention rate. GitLab has a very high net retention rate of almost 180%. That means they're able to extract a lot of money from existing customers. And when times get tough, that's pretty impressive because you don't have to go out and spend money trying to acquire new customers. And you look at valuation ratio. Well, Zeta has a valuation ratio quite low of 2.7. There could be any number of reasons for that. Typically, companies with very low valuation ratios don't have the sort of growth prospects of a Snowflake, for example. So of those three firms, we like two of them. Now, another thing I wanted to point out here that was interesting and came up during this research is this report by Allied Advisors called Flavors of SaaS. What they've done here, they've divided SaaS companies into verticals and horizontals, and that's pretty intuitive. So a vertical will just be in a particular industry. For example, Procure has a vertical SaaS offering for the construction industry. We reviewed that stock. Actually, we wrote a research piece on that. You can simply search our website to find it. And what we prefer are horizontal SaaS companies because they're industry agnostic. So if construction takes a hit, what's going to happen to Procure, right? So we want firms that cross all industries, for example, Snowflake. Looked at our holdings. We're holding, I think, 36 tech stocks right now, a fair number of SaaS firms. We only hold horizontal SaaS firms. That's just because as we've been vetting firms over time, we've just drifted away from anything vertical because of that dependence on a particular industry. Now, we have been vetting some vertical SaaS companies. There's certainly some interesting and appealing names out there, but we've largely been sticking with horizontal. Now, this report is quite interesting. It points to how sales and marketing expenses are much lower for vertical SaaS firms at 22% versus horizontal. Maybe that's because once you get inside a particular industry, word of mouth works a lot better. And then also vertical benefits from lower R&D spend and higher operating margins due to operating efficiencies. That makes sense as well. You're able to specialize. So what we're going to do next is take a look at our top 10 list, the 10 SaaS stocks that were remaining during this exercise, and 2 are vertical, Freshworks and Alchemy, and the rest are horizontal. So just to conclude, when you're vetting tech stocks or SaaS stocks, what you can do is go to Blossom Street Ventures and get this same data and do the same work yourself. Consider the benefits of having a blend of horizontal and vertical. For us, we're risk-averse tech investors, so we largely lean towards horizontal because it's less risky. And what's most important isn't our methodology, it's having a methodology. So look at how we analyze stocks and then come up with your own method, and you'll have different tolerances for risk, and you can adjust accordingly. And if you're a premium subscriber, it's quite easy to take advantage of our tech stock catalog. Again, it's 460 stocks. I think there's 25 different fields of data in there, and it's refreshed every month. We're working on this last month's refresh right now. So I'm going to go ahead and put up another video on SaaS stocks and how to analyze them. Before that, please click the Nanalyze logo here on the right. Subscribe to our channel. Thanks so much for taking the time to watch this today.